Hey traders! In today's video, I'm going to walk you through one of the easiest and most beginner-friendly trading strategies out there. It doesn't require any complex indicators or deep technical knowledge. In fact, I wish I had known this when I started, because it's based on solid trading principles that are used by professionals, just simplified for anyone to follow. This method has been back-tested and showed a 65 to 70% win rate. So whether you're brand new or just tired of information overload, this could be the structure you've been looking for. Let's dive in. The only indicator you need on your main chart is the 50 EMA. That's the 50-period exponential moving average. It reacts faster to price than a simple moving average and helps identify direction and momentum. To add it, open your chart. Click on Indicators. Search for EMA. Set the input length to 50. This is the line we'll use to define the current market bias, whether we're looking for buys or sells. Here's the step-by-step for a buy setup. Start with price trading below the 50 EMA. Wait for a candle to fully close above the 50 EMA. That's our signal that the market might be shifting. After the close above, we wait for 2 red candles in a row. This gives us a clean pullback. Draw a horizontal line at the swing high before the pullback started. Wait for a candle to close above that line. Once it does, that's your entry signal to go long. Now, let's talk risk management. Instead of manually guessing where to place your stop and target, we use the ATR stop loss and take profit finder, an amazing free tool on TradingView made by Forex. To add it, go to Indicators. Search ATR stop loss and take profit finder by Forex. Apply it to your chart. This tool automatically calculates a stop loss and take profit level based on the current market volatility using the ATR, average true range. This is way more dynamic and adaptive than a fixed pip value. You'll place your stop loss at the level shown by the tool, and the take profit will be automatically adjusted to match the risk-to-reward ratio set in the indicator's settings. I personally use 2:1. There are a couple of times you'll want to skip a trade, even if the setup looks close. 1. Is that if the price pulls back and peaks or breaks below the 50 EMA before breaking the swing high, it's a no-go. That tells us the bullish momentum didn't hold. 2. If the breakout candle is abnormally large, like 3 to 4x bigger than the average, it's often a fake out. You want controlled, sustainable moves, not explosive ones that burn out fast. Quick break. If you want to understand trading in more depth, I've created a PDF guide that breaks everything down step by step, with entry rules, chart visuals, and risk management tips. You'll also find a curated list of trusted brokers I recommend, platforms with great execution, tight spreads, so you can follow the strategy smoothly. Now let's flip everything for a sell setup. Wait for price to be trading above the 50 EMA. When a candle closes below the EMA, that's your signal to prepare. Wait for 2 green candles, pull back after the break. Mark the swing low just before the pullback. If price closes below that level, that's your short entry. Again, apply the ATR tool to automatically calculate your stop loss and take profit. No guesswork needed. Now let's walk through a few real trade scenarios so you can see how this strategy plays out in the market. In this case, price had been trending steadily below the 50 EMA for a while. Then we saw a strong break and close above the EMA, signaling a potential shift in momentum. Right after that, the market gave us 2 clear pullback candles, both red and back-to-back, without dipping below the 50 EMA. We marked the swing high before the pullback and waited for a close above it. Once that candle printed, it confirmed our entry. The ATR stop loss and take profit finder plotted both our stop loss and target automatically. The market moved upward shortly after, and the trade hit take profit with no drawdown past the ATR stop level. This was the opposite setup. The price had been trending above the 50 EMA, showing strength for some time. Eventually, we got a full candle close below the EMA, flipping our directional bias. Soon after, the market pulled back with 2 green candles in a row. That gave us the structure to mark the swing low, and all we had to do was wait for the next candle to close below that level. Once it did, we executed the short. The ATR levels handled the stop and profit zones, and price followed through with a clean downward move, take profit hit, with minimal volatility along the way. This one started off looking like a textbook buy opportunity. Price had been moving under the EMA, then gave us a solid break and closed above. We got 2 pullback candles, marked the high, and waited. But before we ever got that breakout confirmation, price slid back below the 50 EMA during the pullback. That's an automatic invalidation of the setup. Even though everything else seemed to line up, re-entering the zone beneath the EMA tells us momentum was lost. If someone had forced the trade anyway, it likely would have triggered the stop loss shortly after. In another case, we had a proper trend setup, a break above the 50 EMA, and the 2 pullback structure. But when the breakout candle came in, it was massive, several times larger than the average candles leading up to it. This kind of impulsive breakout often leads to exhaustion or false breakouts. We stayed out of the trade because the disproportionately large candle increased the chance of a reversal. And that's exactly what happened. After the breakout, the market quickly reversed and would have stopped out any late buyers. There was a situation where everything lined up, clean break, proper pullback, and a breakout that wasn't too aggressive. But after entering, the market didn't move cleanly toward the target. Instead, it ranged sideways for a bit, retested near the entry, and slowly drifted toward our take profit. In this kind of trade, the ATR stop loss really proved its value. It stayed out of harm's way despite the chop, and eventually, price reached our profit level. If we had used a fixed stop loss instead, it might have been taken out prematurely. The beauty of this strategy is in its simplicity. You're not trying to predict the market, you're reacting to structure and price behavior with a clear plan. Stick to the rules, use the ATR stop tool to stay objective, and track your results. And don't forget to check out the PDF guide below, and a list of solid brokers to get started on. Thanks for watching, and I'll see you in the next video where we cover more beginner-friendly strategies that can help you level up your trading.